up there. So, all right, I'm going to start with sharing my screen here. And what we're going to do is kind of jump into, before we get into the genius of good structure, we'll kind of set the stage for a refresher on how Jeff and I first learned about this concept. And it really sets the tone for why this type of product and planning is necessary. So let me share my screen and we'll start digging into that. All right, Jeff, can you see everything here so far?
Yep.
Cool.
It's yep, there you go.
All right. All right. So when we first heard about this concept, it wasn't even called Bank on Yourself yet. They called it the Circle of Wealth, actually. And there was a gentleman down in Colorado Springs who drew this out on a napkin to us, actually, in a bar and restaurant over in the Denver Tech Center in Greenwood Village. But we were told to think about our lifetime earnings and wealth as everything that we can capture inside of this big green circle, if that represents our lifetime earnings. And our job is to identify the potential siphons where our earnings and wealth might be exiting this circle, and to also identify the ways that we could capture these things that are otherwise being forgotten or overlooked through traditional planning. And if you're in your working years, this first part will make a lot more sense. But when I think of Bank on Yourself, Pamela in her book, she talks a lot about it being a bank, being your own bank, replacing the banks, that, and that. That's all true. But I also think about this as I'm literally banking on myself. My financial success is dependent on my own disciplines and on my own ability to identify these potential siphons out of the circle. And if you're in your 30s or 40s or 50s or what have you, and if you look at what your average income might be over the coming years, our goal is to start by thinking of how much of that can I actually keep? How much of that can I actually save? And too many of us in this country, unfortunately, have fallen into this trap where we're hoping that what little we're saving will be made up for by having these astronomical stock market returns. And that's just putting way too much emphasis on stuff that you have no control over, unfortunately. And that world is what we call the accumulated money world, where the goal is to just build the biggest asset possible. I want to find the biggest possible rate of return, but there's no thought as to how am I going to get that money back out, or how predictable are those turns really going to be for me? Are they going to happen in the exact sequence I need them to for the first several years of my retirement to be successful? Because they say those are the most vulnerable years. But in that accumulated money circle, in the traditional planning where they use lots of investments and no safer options to blend those with, they really have to depend a lot on luck and skill to turn that into an income vehicle later. And because of the varying rates of returns that it's backed by, you have to be very safe with the distribution rates you're using. And it can be very inefficient that way as well. So there's something called a 4% withdrawal rate. That's kind of a rule of thumb in the investing world with a 401k or an IRA. And what they mean by that is if you have about $1 million saved in your IRA or 401k, the day you turn 65, about 4% or otherwise 40,000 a year is the rule of thumb that somebody should use to pull out of there. So we think that's kind of inefficient. And when you use these kinds of vehicles that are dividend paying whole life because they're backed by a schedule of both guarantees and predictable dividends, and I'll show you a chart in just a moment showing you just how predictable those dividends are, you can muster a much higher safe distribution rate, because we don't have to worry about, is the market going to do well next year? Is it going to be down next year? It's a lot harder to screw up when you're pulling money out of a bucket that you know what your cash value is going to be in 5 years or 10 years. And that's the real retirement part behind Bank on Yourself, is having a much more predictable and certain possible range of outcomes. Anything you might add there, Jeff, on the accumulated money world?
No, I think you're right on. Again, I think most financial advisors kind of focus on the accumulated money circle as their focus. We in Bank on Yourself have kind of a different focus on things that help us stay well or sleep well at night because our clients sleep well at night, and that is, the traditional cash value life insurance. Yep.
So, where dividend paying whole life as a product became the best tool for this way of thinking, it came to that because it addresses three things that there really aren't any other vehicles out there that address all three of these items at once can do. And that first one we already kind of hit on, which is volatility. It's backed by a minimum guarantee and a profitable insurance company that's paid a dividend every year in their existence, going back 120 years in some cases. Only dividend paying whole life can offer those types of certainties. Secondly, life insurance in general, as an asset class, has tax advantages that other products just simply don't have. Roth IRAs are probably the closest thing that comes to this, but tax deferred growth followed by tax-free income, yet you have no limitations as to how much money you can put in or how long you have to wait to touch your money. In the IRA and 401k world, there's all kinds of rules about, if you take money out before you're 59 and a half, there's a 10% penalty added on top of your distribution. And there's a preset list of rules you have to follow that are the only acceptable terms that would allow you to take money out any sooner. So the Roth IRA comes pretty darn close to having the same tax advantages, but it's not quite there. Interest payments that you would otherwise be making to banks. When you read through Pamela's book, she often says you can capture the interest you would otherwise be paying to banks. What she means by that is once your program gets up and running, when you use the correct insurance company that has what we call non-direct dividend recognition, meaning that they still pay us the same dividend, whether we have a loan outstanding or not. When you use those companies and you borrow from your policy to fund things like a new roof, a wall repair, if you're renovating your house, you do not interrupt the dividend cycle or the interest compounding of your policy whatsoever. You'll have the exact same cash value before and after. The projections don't change, even if you have 70 or 80% of your account is not even in the policy during that time frame. So this is the only tool that allows you to make multi-purpose use of your money without having to give up. In the bank world, I have a choice. If I don't have one of these programs, I either pay interest to the bank by lending from them, or I give up the interest I was earning when I take the money out. So if I take 40 grand out to buy a car, that 40,000 is no longer earning any 4.5%, 4%, 3%, nothing. It's a opportunity cost that's often not thought about when people pay cash for things.
It's still earning interest, but just at the car company, no longer in your bank. That's kind of the key. So that's why you want to funnel it through your policy wherever possible. So you're the bank in the transaction. Exactly right.
Jeff, can you be mindful of the Q&A section in case anything comes up? My screen's blocked.
Yep, I can't see anything coming up at this moment.
Okay, we're good. Okay. All right. So in chapter 4 of Pamela's book, which is really kind of the main part we wanted to cover today, she gives examples of the correct way to structure and design one of these. And she starts off by explaining what the wrong way to bank on yourself might be. And Jeff and I lately have even been saying that, this isn't necessarily the wrong way. It's more or less the old way to design these. And unfortunately, this product is so old that a lot of people may have heard about this like 10, 15, 20 years ago. But unfortunately, they're probably referring to the way it was used a long time ago, not the new way it's being designed with all of these special riders and using these companies that have a product that's custom tailored for this concept. But anyways, we have a simple kind of case study to run through to give you an idea of how someone might go about building one of these. And starting with the wrong way, imagine someone's savings goal is 10,000, 20,000, or it could be 1,000 a month, 2,000 a month. the idea is to start with their savings goal, and we have to come up with what the minimum amount of life insurance would be required in order to get the tax advantages that dividend paying whole life has. The IRS gives us some flexibility on how to design these, and they just don't want more money flowing into a savings plan that has a really, really small amount of life insurance. And the amount of life insurance you need is mostly based on your age and how much you're planning to put into it. So the way it works, if you're younger, they probably need more life insurance in there. And if you're older, they probably need less. So that's why we always say there's no right or wrong age to set one of these up. But the reason why the IRS has these rules in place is they say, hey, we're going to give you this tax deferral. You're not going to owe any taxes while it grows. Your dividends are going to be tax free. And if you're also going to have tax free income, well, the IRS will say you need to have some sort of structure. There has to be some sort of minimum amount of death benefit met. We can't have people shoving $1 million into a policy that only has a $30,000 death benefit. That would be kind of taking advantage of this provision they have in their tax code. So imagine somebody to do this job of a $20,000 savings goal needed to have a minimum of about $500,000 of life insurance. So Pamela uses a sailboat analogy, and she draws a hull of a ship that looks much, much prettier than what Jeff and I have drawn here. But imagine this is the hull of a ship, and I'm calling it the SS Whole Life. But what people used to do a long time ago is they'd say, okay, Mr. Client, all right, here's a $500,000 whole life policy. There's no special riders or bells and whistles. It met your objective of the tax advantages, but there's a few issues with it. It has no cash value at all in the early years. You might have to wait several years before you see any sort of return on your investment. And the reason for that is there's very, very high commissions built into this. In that first year, the person that designed it might take in a huge check, it might even be equal to the premium that went into it. But probably the biggest concern with the way that this type of design was back in the day was the fact that there's no premium flexibility whatsoever. So just about every single year, the person that opens one of these up has to really commit to that 20,000 or whatever their savings goal was going into it each and every year without fail. So this is more or less the old way that people used to use these, and it took a long time. You had to be incredibly patient. Whole life does earn a dividend. It does take a while to do that, so it's not bad on it's not a bad tool, but when left on its own without all the special riders, it doesn't quite work the way Bank on Yourself would advise us to. Mm-hmm. Right. There's a second thing that we should add to this that would probably be worthy of having another slide from us in the future. But there's another tool out there that people are using for this similar concept. They're not calling it Bank on Yourself, but they're promoting a lot of the similar features or advantages or what have you. But they're using something called indexed universal life, and where it differs from whole life is it has no guaranteed cost structure. The insurance company can change the rules of how the internal cost structure is on you at any year it befits them. And there's no minimum guaranteed growth rate. And it's much, much harder to predict where your account value might be in the future. And all of those little mechanisms the insurance company puts in there, the changes they can make on you are more or less a back door where they can back away from their promises, and they can do all that contractually. But whole life is very different from that, where everything in there is guaranteed with the cost structure, and there's much, much more predictability and certainty with how it grows as well. All right, so back to Pamela's chapter 4. The right way to build one of these, or how we would build one if we were in your shoes, this is the exact same way Jeff and I have structured our own programs, and I'll give you guys a little bit of a look at my own policy in a moment, just kind of as a deeper case study here. But we'd call this the right way, or even the newer age way to design one of these. So consider the exact same circumstances. Somebody might have a savings goal of about 20,000 a year. And again, these are all custom tailored to your circumstances. There's no one fit sizing for these. We have clients putting in a monthly amount. We have clients putting in a monthly and an annual lump sum on top of that. So there's many, many different ways to design this. But in this right way example, we're aiming for those same tax advantages. And let's assume we have to have the same amount of life insurance, 500,000. So the IRS dictates how much insurance we should have, but what they do not dictate is how we are to go about building that 500,000. They give us lots of freedom and wiggle room with that part. So what we will do is start with that same basic structure as we had on the previous slide with using a whole life contract, but we're going to use significantly less of it. Maybe like 1/5 of what we used on the previous example, maybe only 100,000 in this scenario. And that might have an annualized premium requirement or minimum of about 3,500. And we're well short of that 500,000 minimum that we need. Got about a $400,000 gap. So what we'll often do is add, in addition to that, is a term life insurance rider. If you've owned term life insurance before, what you probably remember or know is that it's very, very inexpensive. In my, example here, that 400,000 might have an annualized cost of maybe just $500. So you can see right away, term insurance costs significantly less than whole life. There's a reason for that though. Term insurance has no dividend of its own, and it has a finite life. So up front, it's decided to have either a 7-year, 10-year, 15, maybe even a 20 or a 30-year structure to it. And often that term rider is going to be custom designed to whatever your trajectory to retirement is, or to whatever your savings plan is. So we've designed these to be 7 pays, 10 pays, or for younger people, they might have a long runway of a 20 or a 30-year term rider that will allow them to fund into their policy right up until the point of retirement. So there's lots of different ways these term riders can be structured. But again, now we're up to that $500,000 minimum that we needed. We did not use a single dollar of excess amount of death benefit. That's probably one of the other wrong ways to design these. Is if the rules dictate we only need 500,000, it would be unnecessary and inefficient to use even a single dollar more than that. I actually see this a lot. I was just telling a client this morning, there's a prominent permanent life insurance antagonist, I'll call him, on LinkedIn in the CFP circles, who loves talking about this concept. And just for his own fun and experimentation, he designed one himself with his so-called insurance expert. And he was even so kind to share the details of that to the whole group that follows him. And I noticed right away that he was using about 2 times the amount of life insurance he actually needed to fit his savings goal. So even though he's a CFP and a chartered financial analyst, and he's been in the industry for 15 years, he still doesn't know these little nuances of what makes it efficient. In fact, his insurance expert did not even know, because if I had to guess, his insurance expert is probably mostly working on life insurance as a protection tool and not as an efficient savings tool. So anyways, back to the design here, we're up to our $500,000 minimum, and we've carved out just 4,000 of that $20,000 budget so far. So the remainder of that 16,000 can go into this flexible rider that acts like the sail on our sailboat. And we call that a paid up additions rider. That's what PUA stands for. And that sailboat is what's going to really move the ship through the ocean, capturing the wind, pulling it through to grow and move quickly. And what that sail does is when I make contributions to it, it's buying paid up death benefit that gets added onto what I already started with. So in this scenario, someone puts $16,000 into that rider, it adds 50,000 on top of the 500 they started with. and that 50,000 is now considered paid up. It never requires another premium to keep that 50,000 on there ever again. And because that's a paid up death benefit that never requires another additional premium, the insurance company does have a one-time cost structure for that. Is a 6% charge up front that's imposed only on new contributions that go into that. And out of that 6%, 4% is what really buys the paid up death benefit, and the other 2% is what pays the financial advisor's commission. So if somebody put $100,000 into that rider of their lifetime, we would collectively make $2,000 from that rider. So it is a very, very low commission structure. In fact, it could be as much as 50 to 75% less than the old way how these used to be designed. Mm-hmm. Probably most importantly, though, is those contributions to that rider are flexible. That $16,000 is their decision every year. Do I want to make that full payment? Do I want to do something less? They're not in any way obligated to making that $16,000 contribution in the future. It's totally up to them. All of the 4 insurance companies we work with, though, they do have some sort of annualized minimum. They don't want you to keep that rider window open forever and never use it. So some of the companies have something as low as like $500 a year or $120 a year, but there is a minimum and there's a defined maximum. And when we design these, the goal is to make sure that it fits with your current budget so that you can withstand any future changes to the downside. So if you have to scale back your savings, we really want the minimum infrastructure to fit that so that it can weather anything that happens with you in the future. But we also want it to be able to stretch your savings goal just a little bit, but maybe not too much, because that $20,000 goal we had will be the set maximum on this design. It can't go a dollar higher once it's set in motion.
Hey, Matt, before you go to the next screen, there is a question. Is this a good time to ask?
Yeah, please.
Yep. So Mark W, he asked the question. So if I pay $5,000 in interest on a policy loan, that increases my overall balance, correct? And the answer is not exactly. When you pay interest on a life insurance loan, that interest actually goes to the insurance company because they took that money out of their general account, which makes logical sense. You, however, are still earning compound interest in the form of annual dividends as if you never borrowed a dime. So think of the fact that, let's say you have $100,000 of cash, you're making $5,200 in annual dividends on a policy that's a few years down the pike. You still earn that $5,200. Meanwhile, you're being charged interest on what might be a $10,000 policy loan. So let's say at 5%. That interest charge is $500. That goes to the insurance company, but you're recouping $5,200 on all of your wealth as if you never borrowed a dime. So that's what we meant earlier when Matt said a Bank on Yourself program enables you to recapture some or all of the interest formerly lost to the banks. Okay, so great question.
I'll come back to that in a moment or two. To share, my own annual statement to show you how, despite the fact that I had a humongous policy loan, my interest growth and my dividend were like 8 times the size of what my interest cost was last year. So the way they amortize those loans, your actual interest cost is significantly smaller than the stated interest rate that they charge. That is given that you're sticking to a somewhat disciplined loan repayment as well, though. But on November 22nd, our next webinar, policy loans is going to be kind of a deep dive topic. So we'll get into spreadsheets with you about how those loans are amortized, so you can see kind of line by line the effect of taking loans and your loan repayments. So but when you repay that loan, you are replenishing your cash value just about dollar for dollar, though. So it's much more fun than repaying a typical bank loan, where your reward at the end of the payment cycle is just seeing a big fat zero on the computer screen of your loan balance. So, right. Let's see. So chapter 10 in Pamela's book talks about banking yourself for seniors, she calls it. And we would define seniors as being anyone over the age of 59 and a half. And that's not just a made up number. I'll get back to that in just a moment, but they call this a single premium whole life. And this kind of structure could be a better fit for anyone in their 60s or older because it has a much, much quicker turnaround on the cash value and the investment part of it. But it would not be ideal for anyone under the age of 59 and a half because in this type of structure, if you take a withdrawal under the age of 59 and a half, because the IRS is giving you certain tax advantages, they will actually charge you a penalty for taking money out too soon. So that's why this type of design is more or less exclusive to anyone over the age of 59 and a half. But it's chapter 10 of Pamela Yellen's book, and she calls it Bank on Yourself for Seniors. And this is a very, very niche strategy inside of an already very, very niche concept. So there's only, I think, 2 insurance carriers in the whole country that offer a product like this. And essentially, where it differs, where on the previous screen, that person might be putting in a certain amount of savings over a period of years, maybe 5 years, 7 years, or 10 years. So we call that more of a level pay design. This is more suited for somebody who's in their 60s and might just want to make a large lump sum transfer and just be done with it. Because you're shoving so much premium and savings in such a short amount of time, it more or less intentionally violates that IRS code where you may no longer have tax-free income, but you do still enjoy tax-deferred growth. So it still has about 2 out of 3 of the typical life insurance tax advantages. And of course, your death benefit is always tax-free. But typical scenario where we see this kind of program making the most fit is if somebody has kind of money sitting in savings or a CD that's coming due and they'd like to just get more out of it, might want to see more long-term stable growth. We talked about earlier how the dividends from these companies have been going on over 120 years in a row. That's a much stickier rate of growth than what banks offer these days, where they might be offering me 4.5% on a CD today, but what's that going to be next year when that CD renews? And the Fed has gone through 2 interest rate cuts between now and then, which are scheduled to happen. But anyway, so in this example here, imagine somebody had about a goal of transferring about 200,000 that might be in savings or an investment, or it could come from anywhere really. But what we're going to do when we design this is, you notice this sailboat has no mast on it. We've stripped out the term rider because we're making a one-time single payment. There's no level series of payments going in. That term rider will be unnecessary. So what we'll do is we'll work with the 2 other components. So it'll be a nice blend of whole life and that single premium paid up additions rider. And what we often see in these programs is they might hit a break-even point where, we'll say on day 1, that 200,000 is going to leverage a death benefit of about 250,000. And by the 2nd or 3rd policy year, the cash value is probably going to equal what they put in year 1. So you're going to see a quick turnaround on their investment for cash value purposes, and it's going to start growing like crazy right away, right around like year 2, 3, or 4. So if you're in your late 60s or early 70s, this could be a much better fit, because if you are looking to start drawing income off of something, you probably want to do that right away. If you're in your 60s or 70s, you don't want to wait 7, 10, or 15 years. So that's where a strategy like this might come more into play. And often if you're in your late 50s or early 60s, we'll often look at it both ways. What would be the advantage of going the single premium route? It might have a higher projected income, but it might be taxable. So we could even compare both ways. Does the traditional route make more sense, or does the single premium route make more sense?
Hey, Matt, you might also talk about the new rider that's come along with some of our companies called a fixed premium paid up addition rider, where you can actually make additional deposits into a paid-up addition rider after year one?
Yep. Yeah, so this is a newer rider that Lafayette Life's offering. So in addition to that single one-time payment on this type of design, they do allow you to make a series of ongoing payments afterwards if you want to, and they do that through a similar paid-up additions rider. It has a lot of flexibility to it, but they really want you to stay committed to it for a couple of years at least. They have a way of if you don't make any payments to it for several years, they might take that feature away from you. But you could, in theory, redirect certain pension payments or interest you're earning from the bank or anything like that and add more on top of this. And that would just be more going into your sale of the ship. And they call that a fixed premium paid-up additions rider.
Mm-hmm. Right.
Right. Before I show a couple of specific examples from my own policy, just a kind of brief comparison there of the right way when you design it like Bank on Yourself versus the old way. Something I might add to that is there's many more ways to do it the wrong way than what we just showed. We believe another wrong way to do this is to accidentally use way more life insurance than you actually needed. That can make it really inefficient. It can make it pretty inflexible too, because if you have more life insurance than you actually need, your minimum is going to be really high. And the second way somebody might do this the wrong way is if you design and implement one of these and then neglect to do any reviews of that program or to do any ongoing education of it, that can also be a wrong way to set one of these up. So we send out an annual review invite to all of our clients at least once a year, and it's up to them whether they want to take us up on that or not. And we can always meet more often, but during those annual reviews, we look at things like, are we taking full advantage of your paid-up additions rider the way it was designed? Are you coming up on the end of your term rider that was meant to be for 10, 15, or 20 years? Those are the kinds of things we'll look at. And we also discuss what would be an appropriate use of my cash value if I want to take a loan. We love the idea of using this to finance home improvements, tuition payments that otherwise you'd be making cash payments for college tuition, purchasing new cars. But we don't necessarily think that it's a great replacement for a traditional mortgage. So I wouldn't necessarily go out and buy a new house and do the whole thing on a Bank on Yourself loan. And the reason for that is the interest rate on loans can adjust. It's not like a huge bank loan where it could all of a sudden become 20% interest, but each year the loan interest can adjust on you. It's somewhere between 5 and 8% is the minimum and maximum that they charge. But those are the kinds of conversations that we often have when we review these policies once you get up and running. All right, I'm going to stop share for just a moment and open up I'm going to actually go back to Mark's question about the loan. Mm-hmm. And I'm going to share my policy statement real quick. Yeah, okay, I got the right thing here. So used to using Zoom that I almost clicked on the Zoom thing. All right. All right, so this is my own policy statement from last January. And I'm kind of directly answering Mark's question from earlier about his policy loan. So last year, I had a total of about 26,000 in policy loans out of this policy. I have 3 of these as a household, but about 27,000 was out of my policy, wasn't even in there for the majority of the policy year. That represented almost 70% of my total account value. And on the year, the use of using those funds as loan interest, it cost me about $107. And what Pamela means when she says you can recapture what you would otherwise pay to banks for financing is kind of right over here. So in the statement, we can dig out what our annual dividend is, and we can also decipher what your guaranteed increase is every year. We kind of have to run an in-force illustration to show that. The insurance company would do well to put that information in there as well, but let's round that up to $1,600. So my policy grew by $1,600, and it cost me $107 in loan interest. So that's what Pamela means. So I had most of my money was not even in there, and I still earned the same dividend and growth as if I hadn't borrowed at all. So when I needed that 26,000 for various things, my options were I could pay cash, I could pull it out of my brokerage account, and then those investments would no longer be earning me 5%, because that's just how brokerage accounts and savings works. Or I could have borrowed from a bank. If I was buying a car last year, I think loan interest rates were like 9.5%, maybe 9%, something like that. I think they've come down a little bit now. So this is kind of the third often overlooked way to finance something, as opposed to paying cash and then losing the opportunity cost of what that was earning for me, or financing it with a bank, which I will for sure be losing all of that interest to the bank at a much, much higher interest rate to boot. And back to the topic that we had here, that genius of good structure. If we were not using the right insurance company, none of these things would be possible. Lafayette Life, who's the insurer on this policy that I have, they are one of the companies that has non-direct dividend recognition. And if I had instead done this with, who are they, Jeff? Northwestern Mutual.
Yeah.
And I think even Guardian has a cool whole life, but they have a really strange dividend and interest accounting. With Northwestern Mutual specifically, I would have earned no dividend last year, even though I took out just 60% of my account value, because they
Actually,
will
I
put
think
you
it's
in
a
a
reduced.
reduced.
Yeah,
Okay, it's reduced.
It's a reduced
Okay.
dividend, but still,
Okay.
same idea.
So they do still pay something. Okay.
Yep.
Cool.
You want to talk about dividends at Lafayette real fast while we have a lot of folks in here?
Yeah. Do you want to?
Yeah, just we were pleased about on the 16th of October, just recently, we got an announcement. You may have seen this as well, but it sort of reiterated the fact that they've now at Lafayette come to their 120th anniversary of consecutively paying annual dividends to policyholders. It's important to note that, you know, most insurance companies are stock held. Stock held insurers, by and large, don't pay dividends at all. A mutual company is owned by policyholders, and that evidence is evidenced by how many units of whole life you own. So if you have a $100,000 whole life policy, that's 100 units of $1,000 of life insurance. And if they declare a dividend, it's paid to you, you know, as of your policy anniversary. But they went on to say that effective January 1st, 2025, the new dividend rate will increase by 45 basis points from what was 5.3% to now 5.75. And that's going to impact all policies sold after 2005, which, you know, everyone in this room would be impacted on a positive level based on that. So that's great news for everyone. You know, on the same side, you're going to see interest rates for policy loans going up because it's essentially tied to Moody's Seasoned Corporate Bond Index. So it might be a incentive to pay down your loan interest on a quicker scale, meaning that if I had a $10,000 loan and I had a 5% simple interest rate and I didn't pay a dime for a policy year, 12 months, I'd owe $500. But if I pay that $10,000 loan down evenly over those 12 months, my loan charge at 5% would be based on half as much loan balance on the average. So my loan charge would be $250. So that's like a 2.5% APR. But meanwhile, I'm earning a 5.75%, you know, generated dividend. So, you know, that's kind of what we're telling our policyholders is pay attention to your loan balances, make sure you're paying down your balances in a fashion that meets with your budget so that you can recycle your money and use it yet again for other needs that might pop up down the road.
Yep. And this story is not unique to Lafayette Life. So if you're on the call and your policies with Security Mutual or Mass Mutual or Foresters or what have you, all of the insurance companies right now are seeing similar announcements come out that the dividends are increasing and that they are still touting their track record of making dividend payments for over 100 years in a row. So it's not just a Lafayette Life story right now.
Mhm.
Lafayette just happens to be the one that produces the most communications to the public. So that's why we're showing theirs right now.
Right.
Jeff, do you want to talk about the performance comparison real quick? Okay.
Yep. This is a report that is produced out of Lafayette Life's home office, and it just kind of reiterates the reason we really like these kinds of companies. We already talked about the fact that mutual ownership, means that we have essentially 100% of the net profits of Lafayette Life after they pay salaries and expenses. 100% of those net profits are paid out to policyholders in the form of these annual dividends. But also financial strength is critical to make sure that they can pay claims in the future. And one of these, which is the capital ratio to, let's see here, which one is it here? Basically the capital ratio, which is the number one, which is at 11.8%. It's the adjusted capital to total assets. Lafayette Life, its parent company is Western and Southern Financial Group, and they are now number one in pretty much all categories. They really focus on having large amounts of surplus, and that means that they have enough money on hand to meet all claims, be it annuity policyholder claims or death benefit claims. They're also joined with 4 different reinsurance companies to help make those dreams come true, if you will. So that's just a nice financial piece to look at.
And one thing I'm noticing is that all of these carriers that are in the top 6 are all companies that focus on their whole life products. They don't really dabble with the index universal life world at all, which I think is interesting.
It is.
Those products seem to be only coming from the companies that have less than stellar financial things going on.
Mm-hmm.
All right, the last thing I wanted to hit on for everybody is just a quick look at the structure of my own policy. So the topic today was the genius of good structure. So this is my policy, like I just showed you, started in 2013. I was 24 years old at the time, and I had a structure almost identical to what we just showed you guys. So I started with a base whole life of about 100,000. And I blended that with a 20-year term rider of about 365,000. So each year I have a minimum annual premium on this policy out of the 3 that I own of about 2,000 a year. And I can flexibly increase that to about 12,000 a year by making contributions to my paid up additions rider. So we design these very much the same way for ourselves as we would for our clients. And what's interesting about mine is the annual part, the minimum part, is something that we pay annually. And then rather than committing to a monthly contribution, I like to keep things super flexible. I'll actually go on to Lafayette Life's website and I'll make payments towards that rider kind of on my own terms whenever I want. There are some weeks where I'll make 2 contributions. I might skip a whole month and then I'll come back and make a whole bunch. But that's all stuff that I do directly on their website. So I use mine for even maximum flexibility, but that does require a little bit more mental process and commitment because it's easy to forget after a few months. So there is still a lot of benefit to enrolling in that monthly auto contribution as well. But sticking to our topic today, I wanted to just take a quick look at the comparing the policy with and without policy loans. So on this kind of first rendition of my in-force illustration here, we'll just kind of pick on years 14 through 20. So I've got a dividend ranging from about $1,100 a year going to like $2,600 a year. And there's no loan assumption made in this. This is just how it looks if I leave the cash in there and never do anything with it. But on a second in-force that I ran, I did show a pretty big loan of about $35,000 and then being repaid from year 15 to 19. And just to demonstrate that non-direct dividend recognition in action, you'll notice that my dividend is exactly the same from years 14 through 22. It didn't change a single thing about my dividend or how my policy was growing, even though I had about 50-60% of the cash value wasn't even in there for 2 to 3 years. And I am showing the full maximum going in there, but just to demonstrate the flexibility of how this was designed and how yours will be as well, or how it already is. On a secondary one, oh, going way too large there. I can lower that to an extremely small number, much smaller than that 12,000 if I wanted to or had to. So just more proof that you are absolutely not committed to that full whatever you build into there. It's entirely flexible, and you can put money in or take money out on your own terms without having to commit to any big schedule of outlays or anything like that.
Perfect. Awesome.
Sweet.
I don't see any more questions on my side. Anybody have questions? And hopefully y'all can connect to the chat. I can't on mine because I think I'm in a presenter role, but anything that, yeah.
There's one. Does the interest rate change with the prime rate? The interest rate that the banks, or sorry, that the insurance companies track is usually what's called a Moody's Seasoned Corporate Bond Index. And it's less, I think it's pretty close to the prime rate, but it's not always the same. And how it works is, I'll pull up my statement again here. This is how just about all the insurance companies handle this. But when my policy anniversary rolls around, which is January, that's when they could potentially reset my interest rate. And they will set my interest rate for the year to be in line with whatever that index is that they're tracking. And when my anniversary came up in January, it just so happened to be 5.55%. And I think it was 5.2% the year before. So it doesn't change monthly or daily. It changes one time a year on your anniversary date. And it's not just me that they'd be picking on when they change that. It'll be all policies with a January anniversary will get that same interest rate until next January. That's a good question, Keith. Thank you. And most of the insurance carriers, I think Security Mutual is the same way, and so is Mass Mutual. But Lafayette Life has a minimum interest rate. They'll never charge less than 5, and they'll never charge more than 8. So it's not like a credit card where somebody can go from like 8% as an introductory up to like 27 a year later if rates go up. So there's a lot more predictability there.
Mark also asks, he can't make the November 22nd event. Will there be a way to watch it, as a recording? And the answer is yes.
Probably yes.
Probably yes.
Yes.
Exactly. Right.
Most likely, probably.
Right.
Yep. All right. So let me see here. Friday, November 22nd is kind of going to be the next call that we're going to host, and we're going to dive deeper into policy loans. I have an Excel spreadsheet detailing exactly how policy loans are amortized and administered from the insurance company level. We'll look closely at that. And I'm also bringing in a colleague of ours named Miles Thompson. He's a real estate investor, and he also is a mortgage broker, but he works specifically with something called an all-in-one loan, which is an alternative to the traditional 30-year mortgage. Apparently, this type of mortgage is really common in other countries, like in Australia and Europe, apparently. I did not know this until I met with Miles, that the 30-year mortgage is really only something they do in the United States. But he's also someone that can help with real estate investment analysis. He can plug in potential deals into this really sophisticated software, and it'll tell you exactly what your return on investment might be after several months, several years, and it'll help you decide whether something's a good deal or not. So if you've ever thought about dabbling in real estate, or you already are now, he could be a helpful person to help you look at what might be a good deal or what not, what wouldn't be a good deal. And then Friday, December 20th, we're going to have a more deep discussion on taxes. In 2026, there's going to be a huge change to the tax code, more than likely, when the current tax rates expire. In 2017, they brought in a new tax structure and they did not put it in permanently. It is supposed to expire unless Congress changes anything. Not to get political, but I really don't see there being enough cohesion in Congress for them to do anything significant about that. But we're going to talk in depth about the tax rules around IRAs, Roth 401ks, inherited IRAs, life insurance, as you guys already kind of got a little bit of a taste for that today, but also annuities. So we'll talk a lot about taxes on that December 20th one. And we are planning, I think I talked about this at the beginning a little bit, but the next two topics that'll probably be a January and early spring topic are going to be long-term care. I'm bringing in a long-term care expert that knows even more about it than Jeff and I do to address that subject. And we're also going to bring in Dan Baccarini from Beacon Capital. He is the, these companies have a million vice presidents, but I think he's like the national vice president for marketing and accounts. And he's going to give us a demonstration from his point of view about how the investment strategy at Beacon Capital works. All right. Unless anybody has any questions they want to type into the Q&A, I'm probably going to wind it down now. I've actually got a gentleman coming over to do some work for me, and I'll probably pay for it with a Bank on Yourself loan.
Perfect.
Yep.
Hey, thanks for everybody coming and attending, spending time with us. We really appreciate it. Thank you, Matthew, for a wonderful job. And we see the same notes here. Great stuff. Thanks for the refresher. Nice seeing you both again. That's coming from Mark. So I can't wait to see the next one. Thanks to all. Have a great weekend and stay safe out there. And remember to vote. Take care. Bye-bye.
All right. Thanks, guys. Bye.